This is the Friday, July 27th, 2018 version of the Market Plus segment. Joining us now is Mark Gold. Mark, welcome back.
Thanks, Delaney. Nice to be here.
Mark, I want to start it off here. We're going to switch things up a little bit here in this Market Plus. Let's have a frank discussion about lending and what producers are doing to kind of manage that lending risk. You work with a lot of bankers. What have you been hearing moving forward as we're getting into these really volatile times now with trade?
Well, particularly with corn prices and bean prices where they're at, and coming off of $8.25 beans and $3.40 corn, there's a lot of concern out there, not only from the farmer end of things, but on the banker end of things. And traditionally, we've seen a lot of bankers lend based on the equity in the farm, and the equity in the farm has always been pretty strong, so they're willing to lend the money. Now when they're looking at it and the equity is backing off and the costs are still high, but the end prices are very low, can they make the same lending decisions as they've made before? And in some cases, we're seeing they're not making those same decisions. So I think it's going to be crucial going forward, and something I've worked with bankers for 20 years and farmers, is to look at a marketing plan. It's okay to lend money if the farmer has a plan, but so many farmers don't have a plan.
What do you think that is, Mark?
Well, you know, FarmLogs came out with a survey of 1,000 farmers, and they said only 7% of American farmers use any marketing tool for cash sales. And to me, that's an incredibly low, really shocking number. And I think farmers have to be aware of options and futures. And I think the reason they don't do it is, we were talking off camera, somebody in your family mentioned that they don't want to add risk to their operation by using futures or options. Well, in fact, these contracts are designed to help minimize that risk. And I think it's incumbent upon people like myself and other people in the commodity business to educate the American farmer on what is the right way to use these tools. Because particularly in our view, long options, knowing what it's going to cost you, putting in a downside protection, keeping the upside open, makes a lot of sense. And we think bankers are going to start looking at guys that have legitimate marketing plans in place, whether it's options or futures or just cash sales. So they know, okay, this guy has a marketing plan. If the corn market rallies, the beans, they're going to sell something. So even though it may not be penciling out today, we know farmers get an opportunity every year to sell grain at, they have since 1972, to sell grain at profitable levels, but they have to take advantage of that.
I think that was one of the questions I've been hearing from producers and other people in the agribusiness industry, is if you have a marketing plan in place and you have been, hedging and protecting yourself, why are we putting or implementing this $12 billion bailout program? Because
only 7% of the American farmers are doing it. Now, obviously our clients have been very happy what we've done for them, protecting them from these kind of things from happening. So our clients are a little bit less vulnerable to it than the guy that's just sitting there hoping and praying for higher prices. And in my opinion, if you don't like the way we use the markets with long options, there are dozens and dozens of commodity brokers out there with different approaches to marketing. Go sit down and talk to 2 or 3 of them. Talk to us, talk to a lot of my competitors. Who do you feel comfortable with? Who do you trust? Make a decision and try them. If it doesn't work out, it doesn't mean marketing doesn't work. It means you need to find a different marketing guru to help you with that. So with only 7% of farmers doing it, we need to get that number up where they understand these tools that are available to them.
And it's definitely a time when I would be looking, if I were farming, to be doing that, because we've got so much going on with trade and whatnot. And that leads us into a social media question here. Jeff in Lincoln, Nebraska wants to know, do you think China has figured out a way not to have to import any soybeans or soybean meal from the U.S. yet?
Well, there was just a blurb on the news today that the Chinese are looking for substitutes for the meal. So we know that they're going to try to get around this. We know that they're going to book a lot of Brazilian beans. They're going to book a lot of Argentinian beans. Are they going to be able to get enough? Probably not. But with our beans at such a discount now because of this trade war talk, they can afford to buy our beans down here. And in fact, if I was the Chinese, I'd buy everything they could and then say, okay, guys, the tariffs are off, and they'll do very well with that. Are they going to do that? Probably not. But the fact of the matter is they have other sources for protein. They have other substitutes for protein. So hopefully we get this thing resolved and we don't have to see the rest of the world pick up the slack from the Chinese. It's a big slack. It's The EU is 15 million metric tons. The Chinese are 90 to 95 million metric tons. We've got a lot of slack to pick up there, but hopefully things get negotiated out well for the American farmer.
I was at a soybean conference this week in Colombia, and we had a discussion about how much could China really substitute another product in for meal. From your perspective, how much could they raise it? I mean, 10% substitute? What's the total percentage?
I don't know that anybody really knows the answer to that, but they can do things. And can they even get a hold of American beans? You bet. There are a lot of different ways to import beans without directly coming through the United States. And are they going to do that through other countries? It certainly is possible.
Well, that's a good segue into a social media question. I'm going to skip down on the list here because we have one I think that goes off of this well. Boyce in North Dakota wants to know, is the EU planning to buy soybeans cheap now and resell them to the Chinese tariff-free later on?
Let's hope not. I think the EU needs the beans. They are getting them cheap. So can they step in and buy a lot of beans down here and corn if they want it, and wheat cheap? They can actually get cheaper wheat from Russia at the moment, but that's moving away. But right now, corn and beans are certainly viable for the EU. They need it. Now, if they were to step in and buy 25 or 30 million metric tons of beans, are they thinking that they're going to resell 15 million of that to the Chinese if the tariffs are lifted? Maybe. I really don't think they want to play that game. It turns them into a huge speculator, and if it doesn't work, they've got a lot of answers to answer for with their own people.
Yeah, they definitely do. It's kind of a slippery slope to slide down.
Yes, very slippery.
Let's take another social media question here. At Grains Girl, what is the likelihood that whatever happened to reduce spring wheat yields will also work to reduce either soy or corn yields in spring wheat areas?
Well, I think we saw the heat during pollination with this rapid maturation of the crop that we've seen, and I think it's going to do some damage out there. Is it enough to really knock these yields down, to bring the carryouts down? I don't think so. We've got strong demand for corn, which I think can help that and should offset the national increases that we expect over the next month or two. But if it stays relatively dry, it doesn't have to get necessarily hot, but dry, we're going to do some damage. And then as far as the beans go, we're heading into that time in August where we're going to make or break the bean crop. If it stays dry, doesn't have to be necessarily hot, we're going to do some damage out there.
Absolutely. Mark, one more final social media question. I think it's a good one to ask on because I think it's a question a lot of people are asking. Tim in Crookston, Minnesota wants to know, with the newly announced trade or relief package for farmers, does this mean the trade war is going to be a long-term trade war?
Well, I think that's a great question. It certainly seems like the president has dug his heels in. The Chinese have dug their heels in. The trade representative testified the other day that he thinks this could be a long battle. I'm hoping everybody comes to their senses and realize that trade is great, but the president wants to make sure it's fair and balanced trade. The Chinese want to keep taking a lot of our products and intellectual property. That needs to be addressed, but hopefully they can find some kind of common ground.
What about any common ground? Have we been finding any common ground in the NAFTA negotiations?
Well, I think we're getting pretty close, maybe in August, of settling at least with Mexico. I think the Canadians and Mexicans want a joint agreement with the U.S. and not do it separately. It looks like the president wants to go Canada one agreement, Mexico another agreement. But I'm hopeful we can get something done. I think the president would like to do that before the midterm elections.
Absolutely, and those are coming right up.
Yes.
Mark, thank you so much for your time.
Thanks, Delaney. Nice to be here.
Join us again next week when we look at new uses for next generation cover crops. And Elaine Cubb will sit across from me at the Market to Market table. Until then, thanks for watching, listening, or reading. I'm Delaney Howell. Have a great week.